Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and of course, a touch of crystal ball gazing. Today is Wednesday, May 7th, 2025. Today's episode begins with our headline question: how many barrels of crude oil should 1 ounce of gold cost? So what do you think? 5 barrels of oil? 10 barrels of oil? How can we know? Well, throughout mankind's quest to figure out how much things are worth, there is a whole history to the price of crude oil to the price of gold. This chart is from macrotrends.net. Just to scroll up, it is the gold to oil ratio, and it dates back to 1946 and is updated as of May of 2025. And as you can see, for much of the 50s and 60s, when we were still on the gold standard, when the price of gold was pegged to the dollar, people decided, well, I guess it costs 13 and a half barrels of oil for 1 ounce of gold. And then we had various prices going on, 11, 12, 13. And then we came off the gold standard and everybody was like, oh, well, for sure now oil is going to be very cheap compared to the price of oil. And so this chart spiked. So then it became, you had to pay 33 barrels of oil for 1 ounce of gold by 1973. And then after that, it collapsed the other way all the way to 1976, where it actually cost only 8 barrels of oil for an ounce of gold. Lower than when we were on the gold standard, very ironically. We also had in 1982 a low of almost around 9 barrels of oil for 1 ounce of gold. And very highly interesting. If you didn't see this chart, you would have never guessed that as late as the year 2000 or even 2005 or even 2008, we also saw prices below 10 barrels of crude oil for 1 ounce of gold. Now, in this 74-year history of gold to oil ratio, we can also see when gold was a lot more expensive relative to the price of oil. And granted, this has to do with the fact that oil and gold sometimes go up and down in price, but when you compare them against each other, we have sort of a normal-ish range that mankind has sort of figured out over the past 75 years, and it's usually ranged really between 30 maximum barrels of oil for 1 ounce of gold and a minimum of below 10, let's say around 8 for the most part. That's been the range for most of history. I partly bring this chart up because I often have commenters bring up gold. I know it's a popular topic, and of course it's going to be popular when gold is just going up to the moon and seems to never stop. I have people saying, well, Robschild, why are you bearish gold? Are you crazy? This is one of the reasons why, okay? The past 75 years, people have been driving cars. We've been figuring out how much gold it costs to buy a barrel of oil. And right now, it costs 58 barrels for 1 ounce of gold. This is unprecedentedly expensive for gold, or cheap for oil, or it's both. It certainly isn't neither. So either oil needs to go to the darn moon for this to, go back to any kind of historical normal state, or gold needs to fall significantly, or you need to have, at least a little bit of both, which is what I would expect more than anything else, considering the fact that crude oil is at a multi-year low, that the same price has been seen as far back, even in this chart that only goes back to 2018. We've seen this price before in 2018. Has everything gotten cheaper since then? Yeah, oil is either too low, or maybe the parabolic move in gold has gotten a little out of hand. It's probably a little bit of both. The excuse for gold being so expensive is worrying about inflation, worrying about things costing so much more money. Crude oil is not telling this story. And the price of crude oil is very important. It tells a big story. It says how much are people willing to use energy to go out, do things, make things, buy things, travel places, work. Everything involves crude oil. Anyway, I don't want to talk about this for too long, so we're just going to move on to the next headline. FOMC today does nothing and the market doesn't react. If you caught the Federal Reserve release or any of Jerome Powell's talk today, he didn't really say anything and the market didn't really react. Most markets hardly moved. Gold went down during the day, didn't really move that much when the Fed released their information or during the talk. Same thing with gold, not moving much from where we were. Same thing with the 10-year Treasury note yield, not spiking, not collapsing here. Same with Bitcoin, getting a tiny bit of a bid, but nothing to write home about. TLT, going to what I call a neutral zone. I'm thinking we probably are, based on this little pattern here, still headed into this gap fill zone below here, which is where I will be accumulating more. We're not there yet. Also, semiconductors, not closing higher than this previous wick that we had on Friday, so nor bullish nor really bearish in my viewpoint. The value of the dollar itself barely moving at all, not really moving. The real main thing that Jerome said that I saw and that says here in the release that was added to their statement, it says, judges that the risks of higher employment and higher inflation have risen. And there's nothing we're going to do. And you can see in the back of my Powell's mind that while saying that, he's also saying, okay, thank goodness the 10-year break-even inflation rate isn't skyrocketing or getting out of control. And that's giving him confidence that actually the market is saying, yes, we agree with what you're doing, and we're not worried about inflation. This is one of the main things that he looks about. He talks about it all the time, the 10-year break-even inflation rate, something I bring up a lot on the show. Powell is happy with where the 10-year break-even inflation rate is, and so his stance is don't move a muscle. If this starts collapsing, going down the other way, that is one of the really, really big signals that can give the Fed permission to cut. That would be this market saying, hey guys, we're starting to worry that you might be behind the cuts. And I fully expect that we will get there very soon, and we're not there yet. Moving on to the community topics. What moves, if any, did you make today? Robschild bought more of a stock that I recently brought up on the show that has a very notable imbalance on its balance sheet. It has way more cash than liabilities, so much so that if it were to liquidate at its current price, it would be a guaranteed 50% profit. So I bought more of that, around $2.16, I think I got in today. I also got a micro position of UVXY calls, thinking I was thinking the Fed would come out a bit more hawkish here, only because the stock market has gone back up, and one of their main goals over time is for all rates to really go down. He is a part of that, because he does understand the unsustainability of higher rates in our current high fiscal deficit situation. He knows that that's bad. He wants the lower rates just as much as Trump. So I was expecting more hawkishness than what occurred today, which is why I got this little micro position. It didn't play out. Okay, and then we have coming up continuous tariff updates, as always. This is probably going to be on here for the next year at this point. And then Thursday, we have continuous jobless claims, which recently got to a multi-year high last week. This is a really big one for me personally. If this ticks up or ticks up significantly, this will wake up Mr. Market. Mr. Market will collapse if this like really starts to shoot up, because it's the precursor. This is weekly data. This is the precursor to unemployment rising. Unemployment we only get once a month, and it looks back over the last month. The continuing jobless claims is updated every week. It's live data. And so if the continuing claims starts going higher and higher, more and more people are claiming jobless insurance, it's like, yeah, watch out. That's released 8:30 tomorrow morning. As always, thank you for watching, subscribing. The subscribe button's right over here. You just put your mouse over it and then you click subscribe. Thank you for commenting. Love all your comments. Let me know what moves you made today and for your support. This is how you can support the channel. Also in the description. I really appreciate all of the support I've gotten from you guys. You guys are the best. No changes in the daily reminders or macro views. Click the website in the description labeled Daily Reminders Macro Views to read my explanation of these very important items. And no major changes to the crystal ball ratings nor Robschild portfolio here. Moving on to the charts, let's start with SPX, the S&P 500. I've been talking about this looking like a blow-off top. Now we're starting to see sort of a lower high, lower low at the moment is kind of what I'm seeing. I have no idea what Mr. Market is going to do for the rest of the week, but continued jobless claims tomorrow, 8:30. That really could be a really big one. That will collapse markets in my estimation if it comes out higher than last Thursday, actually, because we hit multi-year highs after going sideways for a long time in that chart. Tomorrow's big. I mentioned yesterday, I think that report is going to be bigger than the FOMC meeting. And so far, I still might be right. The FOMC meeting was like nothing. It was like Powell may have just stood up in front of the microphone and just not said anything, just like stared everybody down and then for an hour and then just left. I'm not the only one expecting potential greater volatility coming. The VIX is still, it went down today, but it's still highly elevated. And again, we are still in complete backwardation in the VIX futures term structure. The institutional money that sells these contracts is saying, we are not giving you guys discounts for these options because we are concerned that things are going to move a lot in the near future. So hold on to your hats. The volatility is not over. The VIX is screaming this right now. While the VIX, that tracks the volatility of the S&P 500, the MOVE index, which tracks the volatility of bonds, is still continuing to cool off here. I find that to be interesting. I will say that if we get like another like violent move to the downside in stocks, the MOVE index will actually spike, not because bonds are collapsing, but because bonds are spiking. Typically volatility indexes, when they're high, it's because things are falling, because when things fall, they tend to fall quickly. But volatility also can include bursts to the upside. One market that did make a bit of a larger move than most other markets is Dr. Copper, with a PhD in economics, dropping 2.85%, but still within this chop range here. Definitely something to keep an eye on, especially for the rest of this week. Or is copper falling here? It will fall, by the way, if the continued jobless claims tomorrow comes out high. Again, I think that's the biggest news of the week, tomorrow's continued claims. Another chart that caught my eye today, I don't know why I didn't catch this last Friday when it was released, but this is the commercial and industrial loans, all commercial banks. This says how much are banks lending. So it's a combination of people willing to accept the interest rates they have to pay on borrowing money for businesses and the willingness of the banks to lend at an agreeable interest rate. When that happens, this expands, it goes up. And I'm just going to say that, since November of 2024, we actually got a higher high in March of 2025. This is like expansion. During the Great Financial Crisis, this also expanded before rolling over to the downside and then continuing down after the recession. But in the dot-com bubble burst, soon as it turned over, that was the beginning of that recession. So this going to a new multi-year high, it simply takes some of the winds out of the sails of the bears. That's the way I'm looking at it. Last chart of the day I want to bring up is EWZ, a Brazilian equity fund. If you haven't seen me talk about this before, might as well scroll out and show the big picture. Since 2008, we had this fund worth $102 all the way back in 2008. And since then, we've been making this sort of like ginormous wedge. And more recently, we've had this smaller wedge. And even more recently, we broke out of this wedge and are retesting it along with a horizontal line that connects this pivot point here. We also see this line near other bottoms. It's sort of an important zone. From a chart pattern standpoint, if I wasn't already levered to the teeth in EWZ with a fund called BRZU, it's a leveraged ETF of Brazilian stocks. If I didn't already have that, I would see actually today specifically as a huge buying opportunity. Not just for the chart pattern, but this fund by itself pays somewhere between an 8 and 10% dividend. So every year you get, almost 10% of your investment that you put into it. Over 10 years, you already got all your money back. Huge divergence between that dividend and the S&P 500 dividend of 1.3 or 4%. This is many times as big. And if the price were to go back to any kind of, more normal expectation of a price for stocks that are paying out that much cash, this thing can explode to the upside hugely. So like I said, if I wasn't already levered to the teeth in this fund, today is literally like the buying opportunity of potentially a lifetime here in my estimation. But I don't know. What do I know? I'm just a guy with a crystal ball, and that's all from me and my crystal ball. Hope you enjoyed, and see you next time. Robschild.